Okay, welcome everybody. Episode 88 of the Volatility Barometer podcast. I just spilled, half a cup of coffee all over my desk just as I was about to log in. So that's always nice. But thanks everybody for joining today. I don't know, maybe it's just me reeling from this unbelievable news week. I don't know. It's been a little bit emotionally draining. Any one of those headlines, it's just been a shocking week. So if you're American, obviously, going through this, tough. If you're not American, like me, I'm a Canadian, but still, the United States is somewhat the center of the universe as far as, all of the rest of us in the world are concerned. And crazy stuff. Sad, shocking. Like I said, any one of those would have been enough, just one of them. The first thing, we've got the debate that was, I think most people were probably paying attention to what was going on, but just having a stark realization for a lot of people anyway, that perhaps the sitting president is not able to, perform the job. That's pretty shocking in of itself. And then, of course, you've got the assassination attempt. I don't even know if I'm supposed to say that on YouTube or not, but you've got an assassination attempt, just absolutely terrifying stuff that apparently a pretty decent percentage of people were not able to come out and condemn, which was incredible. And then, just recently, we're just coming off it. I'm not on social media very often, so try to stay off as much as I can. So I was probably late to the party, but realizing that the, again, sitting president of the United States is stepping down, or not from the job, but, not going to run a second term. Any one of those things at any other time in history, we would have lingered on for quite a while, but it just seems just rapid succession. So anyway, it's all been kind of a whirlwind. Hopefully everybody's doing all right. Hopefully everybody's still trying to remain confident about the future, certainly within the U.S. and outside it. And yeah, here we are. We're not a political channel though, so let's get right into the plans for the day. We're going to be talking about trading, of course, not all the crazy political stuff, but we're going to talk about, of course, the reverse split with VXX. I always like to review these things because it does freak people out when they see that the price is going to make these massive adjustments. And a lot of people on social media are going to be using it as an opportunity to either say they made a whole bunch of money when the price inevitably goes from, say, 10 to 40 on Wednesday. We'll get into all of that. And then I do want to highlight, this is more answering specific questions of, is the market crashing? When are we going to cycle out into safety? So I wanted to show a little bit of statistics on, when we cycle to safety, certainly, but also why we cycle to safety, right? I can maybe illustrate why, certainly here at VTS, we are not buy and hold investors. And I can, show you a few charts and stats and stuff to illustrate why exactly we are not buy and hold investors. And then, of course, questions. Again, I guess I led with some political stuff, so perhaps people are going to ask. I always make the judgment call. Am I going to actually answer it or not? If it affects the markets, I will always answer questions no matter what the topic. But who knows? I don't know. We'll open Q&A, ask me anything. I'll kind of decide as we go. If I'm choosing to punt on a question, which I almost never do, but I will still kind of show it for everybody else, and then I'll say, that's going to get me in trouble if I answer. But, feel free to ask me anything. And of course, where's my little tab here? Off-topic stuff is always welcome, but of course I prioritize everything else. This is a trading, it is an investing podcast, but we're human as well. And what we're going through is pretty wacky stuff. So anyway, let's get into the first segment. Okay, like I said, we have a VXX reverse split happening. So let me just show you the announcement really quickly here. This is what it looks like. I guess I should have mentioned if something's wrong with the volume, then, feel free to shout at me in the comment section. I think everything looks pretty good other than the fact that there's coffee all over behind my computer, but we're going to worry about that later. We'll clean that up in about an hour. So here's the announcement. This is coming from Barclays, of course, for the VXX and the VXC. Now, we're not going to focus on the VXC. Not a whole lot of people trade it. We do within VTS, but, we're going to focus mainly on the VXX. And you can see here it's going to be a 1-for-4 reverse split. This is going to be happening effective as of Wednesday, July 24th. So Tuesday night, everything will be normal. Let's just look in on the price right now just so we have a sort of a baseline. VXX right now sitting at about 11. So, roughly speaking, Tuesday night, let's assume it's going to close at about 11. And then Wednesday morning, it's going to be reflected that there was a 1-to-4 reverse split. So this is going to be the 8th reverse split for the VXX since it launched. And, as far as VXX goes, they are all 1-to-4. You can see I also showed the UVXY. They depend varying on how low the product goes, but VXX has always been 1-to-4 reverse splits. You can see it on a chart here, obviously very diabolical. These long volatility ETFs, of course, they are short-term holds only. They are insurance products. They're not meant to be held long-term. Buy and hold, it will go to zero or effectively zero. But, as a short-term thing, people do hold these products. So I do want to just remind everybody, reverse split has zero effect on anything. This is just something that perhaps on your end, it might look a little bit surprising. If you're holding it, just want you to prepare for the fact of what's going to happen. So like I said, if you are holding a position, first of all, make sure it is just a short-term position. No buy and hold here. That does not apply to any of the volatility products. Side note, including SVOL. I will get to that in a separate video at some point, but SVOL itself cannot be a buy and hold instrument either. But none of them can. But essentially what's going to happen is the price is going to be multiplied by 4. So let's assume that it closes at 11 where it is now. It'll just go to 44. And then the outstanding shares will be reduced by 4 times. So if you were holding a position, absolutely nothing happens. You don't have to do anything. You don't have to sell it and rebuy it on Wednesday. It's just going to adjust by itself for you. And the thing I always draw attention to, of course, when you're dividing something by 4, it is possible there's going to be some leftover shares. So if you are in the situation where there's going to be a partial share, let's say you had 101 shares, it's going to go down to 25, of course. 101 divided by 4, it's going to be 20, you're not going to get that full exact amount. So that remaining individual share, I don't know why I said, I'm just looking at this now, not exactly correct, but the point still remains. Any additional shares, decimal places of shares, 0.25, you're actually going to just cash settle that. So if you were to have 101, you'd have 25 shares in your account on Wednesday, and you'd have a little bit of extra cash. So, of course, I've been emailed in the past. Did they steal my money? No, it's in there. It's just probably going to be such a small amount that you didn't notice it. But they will cash settle it for you. As far as the options go, this is, again, on the surface, absolutely nothing happens. The options do not have any effect either. They are all going to be adjusted automatically. You don't have to do anything. Get to that in a second. But if you hold VXX options, instead of dividing by 4 and multiplying by 4, because with options, you're dealing with clearinghouses, and it's a little bit annoying. Of course, you can't have partial option contracts. So essentially what they're going to do, option contracts, one option contract equals 100 shares of the underlying. That's what they always are. So when you see this thing that says 100, that just represents the fact that that is, technically speaking, 1 to 100, right? All that they're going to do is adjust it so that it's now one option contract equals 25 shares instead of 100. That's the adjustment. And then everything else will be the same. That's the easiest way to do it. And so when you log in on Wednesday, what you're going to see is all of these hundreds are going to say 100 over, or 25 over 100. We can actually see one, a remnant from a previous reverse split. When was that one exactly? That one was last year. So March of last year, because it was a long-term contract, you can actually still see it right there. It says 25 over 100. Now the price right now is 11.01. If we go into this one, you can see that the midpoint right there for the options at the money is around 11 or 12, right? But if we go into that other one, what you'll see is these prices are extremely low. This is a reverse split that happened a long time ago, and it's still hanging out there. But on Wednesday, they will all say 25 over 100. And this one will actually say, something different. You can actually see it with UVXY as well. There's some leftover ones. You see it says 20 over 100. Why 20 instead of 25? It's because the last reverse split was a 1 to 5. So the 100 is just divided by 20. But you can see this one says 2 over 100. This is a remnant of 2 reverse splits ago. So that one is including a 1 to 10 and a 1 to 5. It's going to be a little bit confusing. But if you ever see an option contract, go back to the VXX, that doesn't say 100 next to it, don't initiate positions on that, of course. Oftentimes, it's not going to happen anyway, but those are the old contracts. So for roughly, I'm going to say, this happens really, really quickly, but I'm going to say a day, maybe 2 days at the most, it's going to say 25 over 100, and you're just, no option trading for that. Anytime that they say 100, that means that it's already a new option string that the market makers have made available, and you can trade those ones. So this is where it kind of gets into the fact that I always recommend people to close out any option positions before the split. So either today or during the market tomorrow, if you have VXX positions open, it is a good idea to just close those down, because while technically speaking, the contracts will just keep going, they're not going to be closed on you, but the liquidity might become a problem because everybody's trading the new ones, the money, market makers focusing on the new contracts. So I would personally get out of all VXX option positions right now, and then you can either wait a couple of days and reestablish with the new contracts that say 100 next to them, so you're only looking for the ones that say 100, or you could just create a identical position in the UVXY. Because we have to remember that although VXX and UVXY, they sound like different products, they are both holding the exact same VIX futures. It's just a 1.5 times leverage. That's really the only difference between them. So you can always establish the same position in the UVXY if you wanted to. And those are plenty liquid as well, so you can go ahead and do that. So now what I thought we would do really quickly, just because people kind of like to see the decay factor of volatility products. I just want to remind people sort of simple calculation-wise how those go. So what I did, you're probably aware that we have a spreadsheet in the VTS community, and you can get it by signing up for a free trial. There's a free 2-week trial for everybody. So for example, if you were to go on the website, volatilitytradingstrategies.com, go ahead to subscribe for the free 2-week trial. You will not be charged for 2 weeks, but inside that free trial, there will be a spreadsheet download for you. And I've gone over it plenty of times. I'm not going to do it again, but there's a lot of volatility data that you can get for free, as well as some other tabs. I added a little one over here. I will just keep this for the next update for people. But this is a VXX price decay calculator. So super simple stuff. I didn't use any complex formulas. I tried to keep things as simple as possible in case, I've had spreadsheet issues in the past with all kinds of automated data and complex formulas. So let's just keep things super dirt simple. And I can show you why the VXX decays at the speed that it does very simply. These are the VXX prices. And all we're really doing is finding a linear decay path by basically decaying it down until this number equals this number. And we're trying to come up with something that looks like that, showing the decay factor. So for example, if you were to go here and say minus 0.5, right, that's decaying, of course, too quickly, right? You can see that the VXX doesn't decay 0.5 per day. It only decays 0.26. If you were to do, say, minus 0.1, of course, that's not decaying enough. It actually decays more than that. So it turns out the number is about 0.26, right? 1091 to 1092, basically the same thing. So this is the daily decay factor of the VXX. Now, we can use this, of course, both in our trading regularly, but also just for fun to try to predict when the next reverse split will be. So let's just say it does launch on Wednesday at $44, right? It's 11 now, it's going to go up to 44. And let's say long-term, it just decays dead average. We can find the point where it drops down to $11 because that's the average price of all the previous 7 reverse splits. It happened at an average of $11. We can just go down, find 11, right? So that's roughly there. We can divide this. Nope, not that. This divided by 252. And we're essentially talking about 2.12. So let's say 2 years plus 6 weeks, give or take. So right now we are talking about July 24th. The next reverse split will be in 2 years. So it'll be 2026. And it will be roughly mid-August, right? You can see that progression. It'll be somewhere down there 2 years from now. Now, obviously, it can decay much faster than that. There are times when it goes more. If we get a serious market crash, there are times when it's way less than 0.26, but just dead average long term. But what's probably more interesting is just shorter time frames. So let's say you're an option trader and you want to judge based on, say, the next month or something like that. Let's change this to 45, something like that. Let's go down to 37. And there you go. This is a 30-day expected. And so if you were trading options, if you were trading verticals or something 1 month from now, I don't know, say, what is it, 25 days, something like that. Let's just call it 1 month. You could actually use this to get a pretty decent idea of where the VXX should be a month from now, right? So 20 trading days from now, it should be about just under 42. So if you were trying to select your strikes, of course, you'd have to wait for this to reverse split. It'll say something in the 40s, and then you just find your strike a little bit out of the money, and you could actually use something like that to create a decay factor. If you said, well, you know, I think that the market's going to be quite stable over the next little while, maybe it's going to decay 0.35. Again, you can make those small adjustments. You can pick your forward strike and just get a better idea so you're not just guessing. I always find, for me personally, I don't always like to trade at the money. Sometimes, especially when you're dealing with volatility products, sometimes you do get a little bit better risk-reward ratio when you're trying to predict something, sort of a moving target. Everybody knows it goes down, but you know, down by how much? So just a little calculator for anybody who is interested in this data spreadsheet. Of course, the main reason would be the VIX futures, the cash VIX term structure, all of the volatility underlying indexes for all the ETFs, and then, of course, the ETFs themselves, not only to their launch date, but in anywhere that it is possible, simulated all the way back to 2004. So VXX launched in 2009, for example, but it doesn't mean we can't simulate it back because it is just based on VIX futures. So that's the main reason to get the spreadsheet. But again, like I said, now we've got this little VXX calculator that everybody can use, and just makes option trading a little bit easier for people. And for us personally, of course, we do use broken wing butterflies sometimes. So something like that, combined with, I like to do a little bit of extra data based on where the VIX futures currently are, how much contango is in that market. You can judge that the decay will be slightly more or slightly less than the average and get an even better number. But download the spreadsheet and you can run those numbers yourself, and you can actually get a really good calculator for VXX is going to be 4150 3 weeks from now, right? If everything behaves calmly. Now, obviously, if politics get involved and, you know, markets do what markets do, it's not an exact science. It's just, you know, it's better than saying down, right? Down by how much is better than just down. So probably have much better luck trading your options if you have at least a really good starting point. So there it is. No big deal. VXX reverse splits all the time. This is the 8th one. It will keep reverse splitting until these products, you know, for as long as they're with us. UVXY is leveraged, so it splits even more. Round and around we go. But it does tend to shock people when it happens. So just a heads up, it is essentially a non-issue. Okay, so the other thing that we wanted to talk about, I want to show you my daily email, and we are where the market currently is. This is my email from today, and you can see we trade many different tactical strategies at VTS, and I'll get into what that means in a second. But you can see these dials, these trade dials. We are in the SVXY, but we got very close to shifting out into gold, into our safety gold. Here is the defensive. We are in the NASDAQ still, 2 times leveraged NASDAQ, but we got close to moving to utilities. And in the third one, we are in the S&P 500, but we got very close to moving to real estate. So first thing, of course, real estate, utilities, and gold, they all move differently. So when we move to safety, we are moving to 3 different assets, and we move at different times as well. And then the third thing is they are all three strategies based on different underlying volatility metrics. So while they do sort of have correlation with each other, all three of them have different volatility metrics, different thresholds they move to safety and long vol, et cetera, and different asset classes. So even though they're kind of correlated, it is diversification. And they do work well with each other. But what I wanted to illustrate is what happens when we move to safety, because we're so close that who knows, this might come up today, it might come up tomorrow. Here we are. So right now, market did recover a little bit, so thankfully we didn't cycle out into safety. Now the truth is this, although it looks like, oh wow, 3 big down days, this isn't actually that much. So 5552, let's just see how much it was down. I think it was like 2.7 or something, but 5552 minus, and then the other point at the all-time high was 57.15. So we'll just call it more or less this much, 57.15. We're talking about 2.85%, and it's already back 1%. So we're talking about essentially a 2% down move. Now, we're not ideally going to cycle out into safety on every 2% down move in the market. It does occasionally happen where we just nail it perfectly. Like the best example that I've ever had was Q4 2018. We cycled out very quickly in that event. Volpocalypse in 2018, we were out of the market on January 29th, completely into safety. And then, of course, a few days later, Volpocalypse happened. It does sometimes happen that way where even a very small movement can signal a move to safety. But basically, you don't want to cycle out of the market every time it's down 2% because it happens all the time. You just repeatedly be getting whipsawed at that case. So glad it didn't cycle out and glad to see that the market has recovered a little bit today. But it might actually happen. Who knows? Maybe tomorrow we'll be emailing all of you and it's time to cycle out. So let's get rid of all those windows. And I wanted to sort of show everybody why exactly we moved to safety. And what better way than actually to see it on a chart? So these are our strategies. Of course, they are not buy and hold. Nothing we do is buy and hold. All 5 of them have mechanisms to move to safety. But the ones we're talking about today are these 3 here. Hopefully you can see that. Tactical vol in green, defensive rotation in orange, and strategic tail risk in red. That's how we kind of get our rate of return. It's not because we're performing super well during good times. That's not where the performance is coming from. It's actually coming from getting better performance than the underlying markets during bad times. So that's where tactical investing comes into play. This is why it's so important. This is why I always harp on it, because the majority of the time, cycling out into safety and risk management and knowing what to do when things are ambiguous doesn't actually come up that often. Most people don't understand why you would have to do risk management. There's a lot of asset managers who just say buy and hold and just ride it out, but it doesn't actually go down very often. So people don't get to see these examples of what happens if you do actually ride it out. Why does buy and hold suck so bad? Well, it's not because the market doesn't give you great opportunities during stable markets. During stable times, we will be short volatility, SVXY. And pretty much everybody in the world knows that that's what you should be doing when the market is stable. I don't think there's very many people that don't know that stable, low volatility markets are a good time to be net long the equities, right? That is the best time. So this is the easy part. But what we're talking about is why do we cycle out into safety? So I can just show that. This is our gold position in safety. And then, of course, we also have extreme volatility. Happens on about 3% of trading days where we can actually go long volatility. But we're talking about gold. So we can see this, if I just take out the gold positions and just show those, this is what it looks like. Now, the question would be, well, why not just stay in SVXY? Why cycle out at all? So what we can also do, we can go from just the gold. This is what it would look like if you went in the SVXY instead. So not cycling out, just staying in it. That red line is what it looks like. And of course, that is quite terrible, right? A 60% drawdown. Nobody can sustain a 60% drawdown and just make rational investing decisions after that. It doesn't work that way. Even if you looked on a long-term chart, It eventually almost recovered, sure, but nobody can actually do that. You'd pull the plug here, you'd be terrified of the future, and you would have missed all of this recovery. That's what happens. So of course we have to cycle out. And then in the case of this strategy, there is also the extreme. Well, that's terrible as well. So just that 3% sliver is another 55% drawdown. So clearly this is, as obvious as could be, but this is why we cycle out into safety. This is why we have positions for long vol, because if you don't, it is a complete disaster. And this is the part that all of those asset managers make the mistake on. Buy and hold simply doesn't work. Moving to our next strategy, this is just equities. 2 times NASDAQ, very easy to know that you should be net long equities during calm, stable, low volatility, right? I mean, everybody kind of knows that. This is not rocket science. But what do you do during the other periods? That's what's going to make or break it. Otherwise, you're going to give back all of those gains, or at least a good chunk of them. That's why buy and hold during a bull market, it looks great. But then, of course, long term, you're going to lose at least half that compound annual growth rate. So what happens? We move to utilities, and this is what it looks like. Just pulling those utilities positions out of the strategy, this is just utilities, about 15% of trading days. What were to happen if you stayed in the QLD? It looks like that. This is why you don't buy and hold. When volatility elevates, the last thing in the world you want to be doing is being in aggressive market positions, because that's where all the bad things happen. Doesn't actually punish you that bad during stable markets. If you were to just separate the QLD in good times, everybody in the world is going to get the same level of performance. But the reason that some investors are very good and most investors are quite terrible is because of that. Because they don't know when or how to cycle into safety. This is the whole point. And then again, this strategy has a little extra segment of cash. It's not long vol, but there is another drawdown there. So this is showing our strategy is in cash. What happens if we stay in the XLU, which is already safe? Well, even that is going to suffer drawdowns. You have to get out of even that because it's not long volatility. Utilities does have a positive correlation to equities. So you also have to exit that. In the case of tactical vol, we can exit to long volatility and actually profit from a crisis. Utilities will not profit from a market crash. They will also go down. They will just go down less than the equity markets will. So you can stay in the utilities for a while, but then even those you have to get out because there's another 37% going down. Here, 57 drawdown plus this one, that is obviously very ugly. And then similar situation with our third strategy, but this time we were cycling into real estate. The only difference here, and VTS members know this, here's the real estate ETF during mid to high volatility. It's still okay, but there is that extreme underperformance in the last couple of years. Of course, you'll probably know why that is, but I'll show that in a second. But even that, compared to the S&P 500, you can see it's actually performance-wise, it's better to be in real estate. Now, for us personally, we stopped using real estate a couple years ago. We just had cash, so we actually didn't have this massive drawdown that lasted, at this point, 2.5 years. We had cash most of the time. But the reason for it, of course, is interest rates. I'm sure you knew where I was going with this, but with rising interest rates, things like a utilities ETF, for example, things like real estate, they do have a component where they are quite sensitive to interest rate. So you would not want to be holding real estate or utilities or bonds or anything like that during a period where the Fed is pretty rapidly raising interest rates. But now we've sort of made the decision that I'm not saying rates are going to be coming down. Maybe they won't. Maybe the Fed will keep them stable. I have heard that Trump is going to put a lot of pressure on Powell to keep interest rates where they are. And I'm basically just making the assumption that Trump's the next president. I think it would be a real shock to me that if he wasn't. So basically interest rates will probably not go down much, but I don't think they're going to go up either. So this is sort of a time when, yeah, it's probably okay to get back into real estate. And real estate does perform better than stocks, at least during this mid to high. During low vol, it's not the case. The SPY significantly outperforms real estate. But all we are concerned about is our safety positions and why we use them, why they are so important. Because during good times, everybody's performing well, right? The reason that we have this track record, and I've said this a lot in the past, but a lot of people will look at a track record during a really good year in the market, and they'll look at the S&P 500 and say, oh, look at that. You underperformed the S&P when the S&P was doing really well, right? This is actually pretty common. I've said it many times, but it's actually difficult to beat the stock market when it's going up, right? If you have a period of 4 or 5 years where the stock market is mostly crushing it, it's actually pretty difficult to beat that. It's not difficult at all to beat the stock market on a 10 to 15 year time horizon when you're allowed to cycle out into safety, because we know stocks are going to crash epically big at some point. They have in the past multiple times. They will again. So if you've got a long enough time horizon and you can exit into safety in things like the COVID crash, the Q4 2018, the Volatility, 2015, European debt crisis in 2011, obviously financial crisis in 2008, you can whittle away some of that give back that pretty much all investors are going to suffer from. And you can kind of reduce that. And over time, save yourself 3% this year and 5% that year and 3% that year. Even though when the stocks are doing well, you'll probably at best stay stable, but maybe even underperform. But you'll massively outperform during the crisis. And when you add all of those up over time, you end up at a place 10, 15 years later where it's not even close. You're not even looking at the same thing, right? That's what track records tend to look like for people who are effectively cycling into safety and have risk management. Over any individual year, or even 3 to 4 years of good times, like from 2012 to 2015, right? Stocks did okay. From 2016, 17, they did fine. From 2020, right after COVID, pretty much all the way up to now, minus this big drawdown. 3 out of those 4 years, stocks were crushing it. It's actually not so easy to keep up to stocks because you end up getting what's called whipsawed, where you exit to safety and then the market keeps going up, and then you kind of track the market for a while. It dips down a little bit, you exit to safety, wasn't necessary, the market still goes up, and you end up getting these little paper cuts. But eventually when you exit to safety, it's going to be one of those times where you saved yourself a 20% drawdown. That's why we do it. So visually speaking, it is, in my mind, I don't know if I'm doing a good job presenting it, but to me, it is clear as day why we always remain disciplined. And when those dials go into the safety positions, I'm not one of those people that say, you know what, I don't think the market's going to crash this time. I'm just going to ignore the signal. I'm just going to stay aggressive. I don't do that. If it shifts to gold, I'm in gold. If it shifts to here, we're going to utilities. That's just what we do. Because the consequences of getting it wrong just once in 10 years can cost you a long period of your investing time horizon. You really have to be careful. Most of the time when you cycle to safety, it's going to turn out in hindsight that you didn't need to. But every now and then, you really do need to. So this is why we do it. This is why I'm always a very disciplined investor. Been doing it for 18 years. I've had plenty of false positives where I move into safety and I end up looking like an idiot. Oh, look at that. The very next day, the market bounces and I just lost 3%, right? It happens. But every few years, you look like a rock star. And that outperformance during the big crashes, that's how you separate from the crowd. I would encourage people not to view their results by, I'm going to improve performance by taking on more risk in good times. I would say the most efficient way to get a good rate of return is to improve your performance during bad times, right? Focus on risk management. Don't focus on chasing big gains. And might take a while to look like you know what you're doing, but eventually it will just be as clear as day. So we're very close to exiting to safety. We'll see what the market looks like over the next few days. It's up 1%. Well, that's on the ES. It's up 1.06%. So obviously I am skewed positive to that. I am very net long the market right now. So I would like to see a recovery, but who knows? We're going to be ready with our safety positions. So that answers all those people's questions, and hopefully you as well. Hopefully you who are not in the VTS community can realize that at some point, maybe soon, you're really going to need risk management. So keep that in mind. Markets do not always go up forever. Okay, we're going to get into this Q&A. I don't know about any political questions. There might be one or two. Let's get into this. So the first question, what caused the portfolio's annual return to be so high in 2012? There's an error message. I hate error messages. And what would be the portfolio's CAGR without this year? So, I mean, the very, very simple answer is that was a monster year for short volatility. And I was one of the very first people trading short volatility. I mean, the products existed before that, right? VXX launched in 2009. XIV, the one that we were using within our strategy to short volatility, it launched in November 2010. So they did exist, but the volume was extremely low. There were very, very few people trading these products. And as far as writing about them and actually having a service that sells the strategies, I mean, there was like 3 of us, right? This is why I always credit people like Bill Luby, who he had his strategies going before I did. So I started following him in about 2008, I believe, something like that. And he was already in there with the volatility strategy before I was in 2012. His probably launched in, I don't know, I want to say 2011, but don't quote me on that, but probably a year before me. I don't know when I started following Vance Harwood, but he's never really had a strategy, but he was talking about the products. But the point is, I was really early to the party. I was trading short vol ETFs basically since the beginning. And 2012 was just a monster year for the short vol trade. It was results-wise, let me think. That's the wrong spreadsheet. I mean, in almost approaching 200%. So pretty much that was the reason. To answer your question, it was what we call the golden era of the short vol trade from 2012 to 2017. But within that period, 2012 was the monster year. Now, the next probably follow-up question, you didn't ask it, but will that ever happen again? Yeah, probably. But what would be required for the short vol trade to have one of those epic monster years? What would have to happen, more than likely, it's not impossible to happen now, but more than likely we would have to see a significant extended recession in the market to where people are terrified, the market gets brutally hammered, maybe not down 56% like the financial crisis, but something down long term. Not a COVID crash. That was a 3-week V bottom. That's not going to do it. We need some significant extended fear. And then on the other side of that, that's when you can get one of those monster years again. So I would imagine that our portfolio will again see maybe not a golden era that lasts 7 years. We don't really know. Certainly the 90s would have been a good year for the short vol trade, probably from 1990 all the way up to 97 would have been a great time to be a short vol trader if they existed. So I'm expecting that to repeat itself. It's just, that's how time works, right? It happened in the past, so it was 12 years ago. But those times will come again. As to what the CAGR change was, you'd be surprised. It's probably not as much as you'd think it is. But I'm going to say probably 4%, something like that. I mean, if you were to just give it a standard 20% year, like our long term is about 23%, I'd say maybe 18, 19, somewhere in there. If you didn't have that, golden era of 2012, I think you could probably deduct maybe 4%. Not sure why you do that. It was live, but if you were wondering, hey, if that's super skewed and that's never going to happen again, then yeah, I would say get into the sort of 18, 19% range, not our current, almost 23. I think that would be a fair deduction, 4%. Because those early years, while I do think they'll come back, those were factually true. They happened and they were good years. So I think they'll come back, but I can't guarantee that. So totally fair to deduct maybe 4%. Okay. How do you deal with emotions during drawdowns? Any tips? I mean, no tips beyond just experience. Drawdowns are terrifying for everybody, right? And so I started investing seriously in 2005, and I launched my VTS service in January 2012. But I had significant drawdowns in those 6 years, and I was not as focused on risk management in those first 6 years. So I had my experiences of suffering drawdowns, having confidence that I will figure it out and right the ship. So for me personally, I'm now on my, 19th year of investing, and I've suffered my drawdowns. I've had my terrible mistakes. I have a video on the YouTube channel talking about my biggest trading loss. I lost 17% in a single month. I mean, that's portfolio wide. That's everything combined together, 17%. As it turned out for me, it was about, $72,000 or something like that in 1 month. That was back in 2010. I've gone through all that myself. And so I know I'm going to recover. I just have that belief. And I've also seen the evidence of that. It's not just some, vapid, I believe this is going to happen. I've done that. So when we had our big drawdown in 2022, we were down 19% that year. And it actually peaked out at about a 26% drawdown in 2022, sort of aligned with what the market was doing. That was a rough year for probably almost everybody. But the reason that I'm able to stay the course is because I have so many years of experience of knowing that whatever's going wrong, probably there's nothing actually broken because the strategies have worked for so long in so many different market environments. All of this stuff, these are very differing markets along the way. So I really didn't make any changes at all. I substituted a strategy in and a strategy out, adjusted the allocations a little bit. It's not always 25 across the board, but more or less I just stayed the course. And I knew that, look, there's nothing I'm doing that's wrong. Sometimes the market is just broken. And in that year, with bonds down, whatever they were down, bonds were down more than stocks. Stocks were getting crushed, bonds are getting crushed, gold was negative, real estate, utilities, emerging markets, commodities, everything was kind of just awful, right? You can't turn garbage into gold. So I knew to just stay the course. But this is a very valid question for somebody who's never suffered a drawdown. What I would say is, who is it? Alex Hormozy, something, maybe him, maybe someone else, but he always says, you can't get confidence by screaming affirmations in the mirror. You actually have to have a stack of evidence that you know what you're doing. And I would say that that's, in a nutshell, what's going on here, is that I just know that I've recovered so well in all those previous times that when I do suffer a drawdown, it's much easier for me emotionally to stay the course. For you, if you're new, for anybody out there, if you're new, very likely you're going to handle it poorly. Like I did in the past, like we all do. We handle things poorly until we fix it and move on and get that confidence. So one thing you could say is trust somebody else, right? It would be easy for me at this point to say, well, I'll get you through it, right? I was writing blog articles in 2022 regularly talking about, man, this is uncomfortable, this sucks, the market's ugly, there's nothing I can do, this is terrible, but we're gonna get through it. Emotionally, everything's gonna be fine, and a couple years from now, we'll be at all-time highs. So you could follow somebody, but the problem there is you're never gonna fully trust somebody, especially someone like me who you found on the internet, right? So I don't know, what I would say is you have to just go through your experiences and understand that preserving your emotional capital is just as important as preserving your financial capital. When drawdowns happen, you do have to make sure that you understand position sizing and risk management, and you understand which asset classes are more likely to be better to hold, or maybe just hold cash. But very likely, you're probably going to make some mistakes. You're probably going to overcorrect. You're probably going to panic sell something in your portfolio that, in hindsight turns out you shouldn't have sold it. You're just going to have to go through the lessons, I suppose. It's a tough one to answer because, man, I did make the mistakes. I've made all those mistakes. I guess I've made all the mistakes so you don't have to. I don't know if that helps, but yeah. Glad you're back. Yeah, that was a long time. 5 weeks, 5-week vacation. It was a little long. Comments on SVOL. I'd rather not do it because it's just going to be a little targeted drive-by of SVOL, and I don't want to do that. I want to give it a little bit of justice. So within our volatility metric course that we're building, SVOL is one of them. Right? We're going to do what is VXX, what is UVXY, what is UVIX, right? What is SVOL is going to be one of them. And I know it's a dividend, a beloved dividend stock. It's not a stock, but anyway, it's very well liked. It's got a lot of volume. So I don't want to do a drive-by assassination of this thing. I want to wait for the actual video. Bottom line, like I said, what I can say is it's not a buy and hold instrument. Of course, it is a largely short vol instrument, and it will go down when the market does, regardless of what they tell you about the VIX calls at the 60 strike. It's not going to save it. It's going to go down when the market does. And of course, dividends are taken directly out of the stock price. So you're not getting anything from the dividend. It is just a distribution that is now a taxable event. So it's one of those weird things that I'm going to have to unpack it in multiple layers. But let's just say I personally don't believe that it is nearly as good as many other people think it is. Why are they doing a reverse split on VXX? Happens all the time. They basically just do this every now and then because, of course, what we know about volatility ETFs on the long side, they are designed as insurance products. They will go down long term. They'll have great periods of performance sometimes, but more or less these things, they're not designed to go down. This is the one thing that I always have to be careful on. People are like, oh, it's manipulated. It's designed to go down and go to zero, and Wall Street's trying to take our money. No, it's not. Insurance premiums are designed that most of the time, yeah, you're going to be paying way too much for those premiums, but they're supposed to be there so that when you need it, maybe it balances out something of the rest of the things you're doing, like house insurance, for example. You're going to pay way more insurance than you ever get back from the insurance company. Most people are going to be in that situation. You're going to pay way more in car insurance premiums over your lifetime than you ever need on those rare times when you actually need it. That's what VXX is. If you buy and hold VXX, you're going to pay way more money than you ever get back when the market crashes. It's going to continue going down. The question is, do you value something that might be able to smooth out the performance on those rare crisis events? What would you rather do? Have no insurance at all and then have a possibility of losing your home? Or would you just want to I'm paying a little too much and add it up over 60 years. It's probably not even close. I'm probably going to lose more than I make, but I'm never going to be faced with that reality that, look at that, I just lost $800,000 in one day, or whatever the instance happens. That's what insurance products are there for. So VXX is doing reverse splits because that's what it does. It's designed to be this way. It's not, nefarious and manipulative. It is just what it is. So a lot of us, we like to short this thing. Not directly. I don't short ETFs directly, but through options, through inverse products. I like to be the short vol guy most of the time. I'm only long vol about 3% of the time. I'm short volatility about 65% of the time. And then we are in safety positions roughly, let's say 30% of the time. So yeah, it'll just keep splitting and splitting every couple of years forever. That's just what happens. Okay, Lucio, thanks for your work. Welcome. Thanks for checking it out. As long as there's a couple people watching, I'll continue making it. This morning, allocated small capital on UVXY. Whenever people say that, I'm going to make the assumption that you bought you bought shares of UVXY. Am I making a correct assumption there? Looking forward to U.S. presidentials. It's already priced in? Question mark. Looks to me that it's, and there's nothing there. Here's another one. How about shorting vol with short term? So that, I don't know. One of your messages didn't come through. It looks like you were about to say something else. Looks to me like it's priced in. So is it priced in? I don't know. This is one of those things where talking politics, as far as the effect on the market, I think I can offer a few comments anyway. So is it priced in? Right now, what I think is priced in, and I think that was priced in last week, is Trump's your president, right? I mean, effectively, unless something terrible happens, Donald Trump's going to win the election, right? I think that, the polls will probably never really show above 65 or 70%, but I don't know. I just can't see it. Maybe I'm trapped in my own little bubble. I don't know. I can't imagine a scenario where everything that has happened so far that he's not going to be in. So anything that is priced into the options market and priced into the stock market, I would assume that the reaction the market had last week is similar to the reaction the market's going to have over the next 4 months. Kind of a big nothing, right? I know a lot of people think that if this president gets in, it's just all hell's going to break loose. The market's going to crash. It's going to be awful. I'm going to make $1 million buying VIX calls. Or if this president gets in, or, the market's just going to rage higher because they're going to get in there and they're going to change the regulations and they're going to do all these things. Nothing's going to change. Absolutely nothing's going to change. I mean, I don't mean any offense to Americans out there, but nothing really changes from presidency to presidency. I mean, little things on the margins maybe, but it's a very slow moving, giant cargo ship. This isn't some little jet ski. It is nearly impossible to make any major changes either way. So I think the market basically just said last week, okay, Trump's going to win, and here's what the market's going to do. Nothing. Just a kind of a big nothing. So is it priced in? Yeah, I would say so. The only wild card, I suppose, would be, and this is just a off the wall political opinion by one person, so don't attack me on it, but I know for me personally, I know nothing about Kamala Harris. I mean, beyond the memes that I see on Twitter, I know nothing about this woman, really. I mean, just an invisible VP. I couldn't tell you policy-wise pretty much anything. I've just seen all the memes. So over the next few months, I don't imagine anything's going to change. I mean, I don't think she was very popular before, and I don't think that's going to change going forward. But let's just say, for the sake of argument, that the Democrats did an exceptionally good job introducing her to the world, and we're all kind of like, oh, wow, I'm actually surprised. She looks like a very viable candidate, great president. Like, maybe that would change the market, but I think overall, yeah, it's all kind of priced in at this point. So if you're trying to make targeted option strategies, thinking that some big fireworks are going to happen on the U.S. elections, I'm just not sure if I'm there with you. I just think that for me personally, I'm a trader as well, and I'm not trading the election. I don't really see any mismatch of anything. Remember, that's what option trading essentially is. You'll do far better instead of looking at trying to make directional trades and trying to predict markets like that. What you're really looking for is, I'm going to buy things that are cheap and I'm going to sell things that are expensive. Try not to be so price specific and like targeted price directional exposure. It's just, you're going to buy UVXY now. Is volatility cheap right now? Like, forget about where you think prices are going. Is volatility cheap right now? Not really, right? It's not really that cheap. So would I buy UVXY? Would I buy VIX calls to load the boat? No, I would only do that if volatility was cheap. I would only sell something if it was very expensive, if it was high premium. Let's say the VIX was at 30 right now, and I was like, the market's saying that this is going to be a non-issue. Of course I'm going to sell that vol. Right now I'm thinking everything's kind of fair. It's just, that's how I view trading, volatility trading. It's more about extremely high volume, high occurrences, large trade occurrences, just getting those tiny edges of, I buy things that are a little bit underpriced and I sell things that are a little bit overpriced. And if you do that, just rinse, repeat over time, you're going to have a pretty great rate of return. Okay. Sleepy man replacement. It's the unknown vol catalyst. Yeah, I think after the debate last week, I think everybody kind of knew that the replacement was coming. I'm shocked it took this long. I think that's devastating to the party, if you are a Democrat. I know we've got a good mix of both. We've got some red team, some blue team. I look at them as kind of all the same thing. But yeah, Sleepy man is gone. And a completely unknown candidate that I personally know nothing about is in. I don't know. I'm going to get into so much trouble. What time is it? 53 minutes in. I'm going to get in a lot of trouble. People are going to come at me in my comments. But it just strikes me as even the Democrats have acknowledged that Trump's the next president, because they can't honestly think that Kamala Harris is going to win, right? I mean, by not having an open convention, by not substituting somebody who's got a far better chance to beat Trump than Kamala Harris or Joe Biden, they're, similar, very low probability for both of them. Even they have sort of conceded. I think what they're thinking is basically, and I'm not a political strategist, but I'm probably thinking that they are just going to punt this election. They know that Trump's got way too much, momentum at this point. And maybe they'll save their really good run of a good candidate for the next time around, because this is going to be Trump's second term. He's probably going to have an equally difficult time getting things done as he did the first term. Like, not really anything changed. The campaign promises, none of them really came true. And I would imagine there's going to be a lot of political stifling this time around as well. So the general public is probably going to be quite disappointed with this presidency. And in 2028, maybe then they're going to try to run their better candidate. So I don't know. Maybe that's what they're thinking. Just, look, let's just let Kamala do her thing, and we'll regroup and refocus for 2028. So it's probably a lock in my mind, but, you never know. USA cannot pay its bills. Yeah, spending is absolutely out of control. And that's not a partisan thing. That is both parties, both Trump and Biden, spent way too much money. I mean, I can maybe understand during the COVID stuff that, spending is obviously going to ramp up to an extreme. But Trump was out there saying it's the greatest economy the world's ever seen, and he was spending like crazy from 2016 to 2019. And now Biden's saying the same thing. It's just the greatest economy everybody's ever seen. Inflation is through the roof. I mean, it's clearly not the greatest economy everybody's ever seen. But I mean, COVID was 3 years ago, and they're still spending just absolutely insane amounts. So yeah, it's nuts. I mean, I'm not an American. First of all, I'm not a voting American. I'm a Canadian. Nobody cares what I think, but I would say I'm fairly close to a two-topic person, where what a president thinks about wars and what a president thinks about balancing the budget. That's pretty much it for me. I mean, all the social problems stem from income inequality and inflation and terrible economy and bad jobs market, but that all stems from overspending and mismanaging capital. So if you can fix that root cause of the fact that the deficit just absolutely insane, all of the knock-on effects get solved, or not solved, but improved significantly as well. And then the war side. So that's all I really care about. And unfortunately, we had Biden-Trump going against each other. Both of them spent an insane amount of money. And now we've got Kamala Harris going against Trump. I mean, what's going to change? No, you're right. I wouldn't say default, because the U.S. will never default. The U.S. is, as I always say, the cleanest dirty shirt in the closet. Just the simple military prowess alone is going to mean that the U.S. is the surviving country. They can put on a lot of pressure, and the U.S. is not going to be the first country to default. If that is a path, like if you said, well, wow, let's go into a time machine and go into the future, and the U.S. defaulted on its debt, I would say, wow, that's amazing, but probably 150 countries defaulted before the United States, right? It's not like we're going to go from this world we're in right now, and then suddenly the U.S. and the world's reserve currency defaults. It's absolutely not going to happen that way. So again, anybody who thinks that the American empire is going to fall, it's not. It's going to be there for our entire lifetime, simply because in order for the U.S. to fall, Europe would have to go first, Canada, Australia, all of the weaker economies, Japan would go. All of this would happen first, and you'd have plenty of runway before you're like, okay, well, now the U.S. is next. The U.S. won't be first. So they're miles away from considering default or anything like that. They'll just fudge the numbers and keep going. They are by far the largest, most influential economy in the world, and I don't think that's going to change in our lifetime. I really don't. Okay. Too much politics? Let's try to find a why the VIX futures shape. I tried to find a trading volatility related question, and my answer is politics. You will always see a kink in the VIX futures anytime there is an event on the horizon. So, sorry, I have to go through this ad blocker. I have to do this 4 times. Sorry about that. And then it's going to go. All right, so why do you see the October VIX future so high and the November one at a somewhat normal price, right? If you would imagine, here we go, here, 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 and here, the other one should be right about there, right? The October future should be a normal price, somewhere around 16.90, 17, something like that. But it's actually sitting way up here. Why is that? Well, the election happens between these two cycles. So if you were an option trader, if you were a VIX futures trader, you're actually, all the action is over here on the October future. Because if you wait this long, that's after the election. Everything, the whole balloon is going to deflate at that point. So this is why this future it's been elevated for months and it's going to stay that way. So that future is due to the election. This, I would imagine, is due to the fact that there is weakness further out in time. Again, the election is probably going to affect long-term volatility for, I don't know, couple weeks, maybe a month. But then the world will probably wake up to the fact that nothing's really going to change, and everything is going to go back to normal. So everything after October is going to be adjusted a little bit, but the October specifically is going to look very odd the entire time. Because the only way it would actually normalize before the election would be if all of those contracts were actually closed out. And that's not going to happen. There are people that are, like our friend up here, sort of pricing in some type of event, and everybody's kind of placing their bets. And those trades are largely going to be on now, right? I think now is not a very good time to get new election trades on. I think that it's probably past at this point. But yeah, that's just going to look that way until the October future expires. But fortunately, and I will say that, this is going to get this question as well. Remember, volatility ETFs are traded based on a constant 30-day rolling VIX future. And the actual buying and selling of the futures, it does not matter what prices these are at. The daily rebalancing from a cheap future to an expensive future has absolutely zero effect on the price of the underlying volatility ETFs. That rebalancing is literally just taking a pile of money from here and moving it here. It is a set amount of money and a different number of futures. That's the thing that people oftentimes don't understand, is that they think, okay, I'm taking, say, 1,000 futures from here and I'm buying 1,000 here. That would definitely be a problem if this one is priced way above this one. But it's not. They're just taking a certain percentage of the AUM of the product and they're moving it from one pile to another. So it is quite literally, it does not matter if they're rolling the daily rebalance from something priced at 10 to something priced at 100. All it would mean is that this dollar value only buys 1/10 the number of contracts. But the notional value from this one to that one after the rebalance is literally exactly the same. You are just transferring money from one pile to another. What actually changes the price of the volatility products is what happens all the time outside of that rebalancing. So imagine the rebalancing takes place in 1 second. The reason that the VXX moves up and down is not because of what happened in that 1 second. That is quite literally just this. Nothing happened. Same notional value goes from here to here. Doesn't matter what price the futures are. What affects the price is the other 23 hours, 59 minutes, and 59 seconds. That's when the slow decay of a term structure in contango above the VIX index, above that spot VIX price, will actually decay the product 70% of the time. That's what's happening. So if you imagine, using my little coffee example here, if I open the top of the coffee and I move it over here, I have the same coffee, right? Nothing happened. I just moved the same amount of coffee from one place to another. But if I leave the top off and I come back in a day, of course, you'd need some type of microscope to see it, but there would have been some evaporation of the coffee in the cup the other 23 hours, 59 minutes, and 59 seconds. That's what's happening with the volatility products. But because it happens day to day and people are seeing the products go down, they actually think that what's happening is you're rebalancing from a cheap number to an expensive number and you're losing something in the trade. You're not. That is a very, very long tangent of something you didn't even ask. So that wasn't directed at you, but there you go. That October future is due to politics, and that will not have any effect on the underlying volatility ETFs. What happens after that? Yes, it will, because those farther out futures, those are going to be buying and selling in an open market, and that will change it. So if the world decides that it's a non-event, then all of those futures will decay at a faster rate, and that balloon will deflate, and the VXX, maybe post-election, could actually go down a significant amount. If the world thinks that, okay, now that Trump is president, now everything's going to go to hell, then maybe those open market VIX futures buyers and sellers are going to push the futures up after the election, and maybe VXX will really struggle to go down. Maybe we'll see a year period where it's flat, right? But just the movement of capital does nothing. And it's the October future, not the November. I've had people say, well, how come it's that? Shouldn't it be in November? No, it's It's going to be like a deflating balloon after the election. Even though for me personally, I've already priced everything in. Like, outside of a miracle, Trump's your next president. Love him or hate him, Donald Trump has a second term in my mind. Okay. Asking again. Yeah, you're right. I did skip your question. I highlighted it and then I just went right over it. Okay. It's sensible short vol with short-term PMC calls, or just go VIX ETP or puts, stock replacement. Well, I would have to know your market bias, your portfolio bias, and then I would have to know what you think is going to happen. Like for me, as I already said, outside of my day-to-day trading, I'm not doing anything additional to that. I don't think playing the election, I don't think there's any juice there anymore. I think that everybody's kind of chosen their positions and all of the low-hanging fruit is kind of long since taken out. So short vol with short-term calls, or just go VIX ETP or puts, stock replacement. I don't know what that would mean, but go VIX ETP. Yeah, I mean, if you can get past the fact that, like for you, you're long volatility. Everything you're saying is, you said you're going to buy the UVXY, and now you're shorting vol, or just go negative VIX ETP, or short puts. I'm sorry, I don't know what you're asking here. We might have to chalk it up to sometimes if you're doing live streams, your brain freezes. You're reading English and you just can't. Sometimes I just misinterpret the questions. I really don't know what you're asking here. Because previously you said you're buying UVXY, and now you're saying best way to short vol. Let me just assume that's what you're asking. The best way to short vol actually varies, just like the best way to go long vol. Gets back to the fact that, like I said, you're not price directional. You're buy things that are cheap, sell things that are expensive. And if you were to take something like, say, VIX futures, VIX options, volatility ETPs, S&P 500 put options, right? These are 4 ways to get exposure to a similar outcome, right? There are going to be different juice inside all of those because they are technically independent markets. So there's going to be times when let's say the S&P 500 options market is mispricing, then maybe you should go into that market. There are times when the volatility markets have not done what you would think should happen based on what's happening in the equity markets. Maybe the VIX futures would be the most efficient at this time. But there's no set, like this is the best way to short vol. They're all largely equivalent long term, but they, each one of them jockeys for position, and sometimes some of them are a little bit more efficient than others. So this is why, for me personally, I open myself up to all of this stuff. I don't have just one thing. I trade all the volatility products. I trade VXX, UVXY. Don't trade UVIX, but SVIX, SVXY, ZIV, ZIVB, VXZ, VIXM. I trade them all in different strategies. And then I trade VIX options. I don't trade VIX futures, but I trade VIX options. I trade S&P 500 options. I just go where the premiums are slightly mispriced. All right. It's like an iron condor. How do you decide if you want to do an iron condor on the equity markets? How do you decide whether you're going to open it on the Russell 2000, the S&P 500, or the NASDAQ? They're all stocks, right? But at different times, some of them have higher volatility. So, of course, you go there if you're selling vol. Similar thing. So I know I completely missed. Maybe reword and try again. In your opinion, poor man's covered call works as a short vol instrument? No. Well, sure, I suppose. I just prefer other ways to go. Like we do the Wheel of Fun, for example. I'm sure you've heard me talk about that many times. Yeah, if you're doing short vol stuff, keep it simple. Go to there's nothing wrong with the volatility products. They're packaged correctly. If you can get past the fact that people think they're manipulated and designed to go down and just trade them as they are, they function really well. So I would say start there and then start it with basic options like verticals on the VXX or something like that. You can do either side. Everything expands out from there. There is no better or worse. There is just slightly more efficient in this moment in time. That's really the best you can do. All right. Not seeing too much else. 2020 was post-election controversy. 2024 is pre-election volatility. So 2020 post-election controversy. Yeah, I guess a significant percentage of the U.S. actually thought there was a problem with that election. I guess I'm not one of them. If 100 court cases can't solve that mystery, then I don't know what would. But I can see where you're coming from. 65 million people voted for somebody that they thought won and lost. So yeah, that's a controversy. And then, yeah, all kinds of wacky stuff is happening this time around. The U.S. elections are insane. I think Americans don't fully appreciate how bizarre your political system is. Like for Canada, we're wacky woke Canada under Trudeau, but our elections come and go very quickly. They're not in your face all the time. It's just kind of, okay, there's an election and eventually we'll get out and vote and maybe I'll listen to a couple of things. But in the United States, like Europe has the same thing. Their elections come and go pretty quickly. Nobody's really so invested in it, right? So from the outside looking in, it seems bizarre. Like it almost seems like the national sport of the United States is politics, which is crazy. It doesn't really matter, does it? At the end of the day, it doesn't really matter. But yeah, everybody, just a 24-hour news cycle, every single podcast in the world, everything for months and months and months is talking about the election. And then after the election, months and months and months about the election you just had. And then, of course, you're going to have the midterm election. And then after that, it won't be long before we're running in, a year and a half run into the next election. And it's just constant. I don't know. It's hilarious. I don't know. And it's probably made worse from the fact that I personally don't think a whole lot changes. So we're all sort of giving our opinions and this is the end of the world if that person wins, and it's just the greatest economy on planet Earth if this person wins, and so vested in the outcome of something that really changes at the margin is the best you could ever hope for. Like it's just not going to matter that much. Let me put it this way, the ratio between how much actually changes and how much people think should change is vast. It's a huge gap between these two. Yes, a few things change, but overall, is it really worth spending, several hours every single day? No, probably not. An election is happening. Let's just chill out, right? And let's certainly not be violent over it. That is insane. Scary too for democracy. That is the polar opposite of democracy. Anybody who cares about preserving the democracy, and this is kind of the hypocrisy that I've been seeing, just as a person outside looking in, you do get people saying that, this orange man getting in is the end of democracy, and yet there is no faster path to the end of democracy than political violence. So, it's kind of a hypocritical. I don't know. I'm getting in all kinds of trouble here. I'm going to shut up. My email inbox is going to be a nightmare. All right. Why the hatred towards VIX futures? I don't hate VIX futures. And if I didn't run VTS, I'd probably even trade them. But I feel like the volatility products function perfectly. Aside from, I know the caveat that VXX broke when Barclays didn't refile the proper paperwork, and TVIX in 2012 broke for a different reason, but similar result, that it totally decoupled from its IV. But overall, they function completely perfectly. So I have no problem doing that. I could probably, pop the hood and understand plenty about the VIX futures to the point where I could either simulate the volatility products myself. It does require daily rebalancing, which would suck. Why bother when there's a perfectly good product out there? But also layers of complexity within a community. it's already difficult for me to introduce options trading, for example. To go from ETF trading to options trading is a lot of videos, it's a lot of live streams, it's a ton of email answering. And so then adding another layer of VIX futures, even though quite similar to options, really when you understand what they both are, it's just another level of complexity. So I don't trade VIX futures at all. I haven't personally in years, and our community never has. I don't hate them. It's like I said, to me, they are an equivalent method of representing a position. Right? Sometimes the VIX futures will be the best spot to do it, and sometimes it'll be the worst spot to do it. Sometimes S&P options will be better than this, but I don't hate them. I just don't use them. When will they do the reverse split? That is going to be happening on July 24th, market open. So Tuesday night, you're going to see a regular VXX price. It's going to be priced somewhere near 11. And then Wednesday morning, July 24th, you're going to see the VXX be roughly $44. That's what's going to happen. So that's when it is. Wednesday. Today is Monday, so 2 days from now. If you have options open on the VXX, I would suggest just best practices, close them out now. No reason you can't close them out now. At the latest, close them out tomorrow. You don't want to use those old contracts anymore. They are still going to be in the feed, but don't do that. So for all you VXX option traders out there, I know probably most of you have positions on. I knew this, as soon as the announcement happened, I had one vertical on VXX. It was profitable, so I just closed it out and reestablish on UVXY for a couple of days. VXX will be very tradable it'll be tradable by Thursday. It'll be totally fine by Friday. So that's what I would suggest. Anyway, hopefully, no offense if I, trampled all over your political guy. I know people take it very seriously. In my defense, in case anybody is really mad at me, in my defense, I've never really cared about politics that much. I've never liked any candidates ever. I've always understood the concept of I like that person more than that person. It makes perfect sense to me. People in 2020 who said, I like Biden more than Trump, that makes perfect sense to me. I like Trump more than Biden. I can totally see that. I could also make a list of reasons why that's the case. What I don't understand are people who actually like that person. Like they say, there's 330 million Americans and that's the best guy. Now you've lost me. If somebody wants to say Trump is far better than Biden, no argument. If somebody wants to say that of all the Americans, Trump's the best guy we've got, you've lost me now. I can't get there. It's the same thing about insert any person. I'm not trying to offend anybody, so let's use them all. If somebody said I prefer Hillary Clinton to Donald Trump, okay, whatever. If somebody says Hillary Clinton's the best we've got, now you've lost the plot, right? Now you're in a place where you have just decoupled from reality. These people that we put forward on our political, podiums, these are not the finest we've got among us. I think we can all agree on that, look, if you were to have a company and it actually mattered to you and your family only eats if the CEO is doing a good job, you're not hiring these people to run your companies. I know that. Hillary Clinton's not going to be the CEO of your company if you need to eat off her, effectiveness. So let's just put it that way, that it doesn't matter to me who you like and who you're going to vote for. I think that's great. I mean, there is differences on the margins, but I'm just never going to fully understand why people actually champion somebody. Top of my head, I can't think of any political figures that make me actually think that, wow, that's the best of the best. That's my guy, right? Justin Trudeau, just 31 million Americans, and he represents the best of us, like the values, the ethics. This is our prime minister, and I'm just so proud. No, you could throw a rock in any neighborhood in Canada and find somebody better than that. So, maybe he beat the other guy because the other guy was even worse, but no, let's leave it there. My emails are open. Hit me with all the hate you want, but no offense to anybody. I just find politics to be somewhat useless. It's just, it's a big tanker ship that's really not going to change. If he can make very slight improvements, That'd be fantastic. That would be progress. So we'll see what happens. Thanks, everybody. Let's stick to trading next week.